After meeting together in order to deliberate and decide, the committee has resolved to grant the BBVA Foundation Frontiers of Knowledge Award in the Economics, Finance, and Management category in its 13th edition to Ben Bernanke, Brookings Institution, Mark Gertler, New York University, Nobuhiro Kiyotaki, Princeton University, and John Moore, University of Edinburgh. Professors Ben Bernanke, Mark Gertler, Nobuhiro Kiyotaki, and John Moore have made fundamental contributions to our understanding of how financial market imperfections can amplify macroeconomic fluctuations and generate deep macroeconomic recessions. In the last 15 years, advanced economies have been hit by large macroeconomic shocks arising from the financial side. What do the great financial crisis, the European debt crisis, and the current COVID recession have in common? The answer is weak balance sheets. By 2008, fueled by the liquidity glut stemming from emerging countries and by lax prudential supervision, many financial institutions of advanced economies had pursued a short-term profit strategy and taken large risks, investing in real estate bubbles, borrowing short on financial markets, getting exposed to poorly capitalized players such as AIG, and so on. The governments and the central banks had to rescue a financial sector that was about to implode and would have been unable to perform its core functions, serve retail depositors, lend to small and medium enterprises, and run a smooth payment system. A few years later, some European economies, weakened by the financial crisis and previous deficits, suffered speculative attacks. Concerns emerged as to the possibility of a doom loop in which low equity banks would jeopardize public finance, and conversely, due to the banks' holding of large amounts of their sovereign's bonds in their portfolio, the sovereign's difficulties would reduce the value of banking assets, calling for public bailouts. In today's COVID economy, part of the corporate sector suffers from weak balance sheets, and concerns arise as to its survival in the absence of a protracted infusion of cash by the governments and the central banks. The macroeconomic effects of weak balance sheets were largely ignored by mainstream macroeconomists before the 1990s, yet their economic importance is substantial. A firm or a bank that is undercapitalized cannot have access to funding, even for very worthwhile investments. The reason for this is that investors are concerned about recouping their money, which a low level of equity or collateral makes less likely. In the same vein, investments are not just determined by the prospects attached to the investment and by the prevailing interest rate. They also depend on the funds available to the entity. For this reason, external funds are more expensive and difficult to secure than internal funds, making investments sensitive to retained earnings. Investments or even expenses needed for the entity's survival are available in good times when the entity has good prospects and/or is deleveraging. However, the situation may quickly change in bad times, with important consequences for economic activity and employment. The work of Ben Bernanke, Mark Gertler, Nobuhiro Kiyotaki, and John Moore sparked an enormous literature that grew particularly rapidly after the great financial crisis of 2008 made the relevance of their ideas clear. Bernanke, Gertler, Kiyotaki, and Moore highlight two important channels through which imperfect financial markets amplify macroeconomic fluctuations and generate economic recessions. The balance sheet channel emphasizes the importance of the state of corporate balance sheets for economic activity. The credit channel shows how weak banks translate into a credit crunch, in which fragile firms, small and medium enterprises, that rely on relationship banking suffer. Following their contributions, it has become routine for economists to look at the implications of balance sheets for monetary policy, for capital controls, for understanding the role of the shadow banking sector and the hazards related to it, and for prudential regulation reforms. Ben Bernanke and Mark Gertler's paper, Agency Costs, Collateral, and Business Fluctuations, published in the American Economic Review in 1989, was first in integrating imperfect credit markets in a dynamic model of macroeconomic fluctuations. Bernanke and Gertler use the model to show how imperfect credit markets amplify fluctuations in real outputs. A reduction of cash flows in economic downturns requires firms to rely more on external finance. This raises firms' costs of capital because of the agency costs of borrowing and results in lower investment, which reinforces the initial economic downturn. Bernanke and Gertler also find that autonomous factors affecting the collateral of borrowers can initiate cycles in real outputs. In Financial Fragility and Economic Performance, published in the Quarterly Journal of Economics in 1990, Bernanke and Gertler go on to demonstrate that in a financially fragile economy where balance sheets have become very weak, the agency costs of external finance can lead to a complete investment collapse, which can only be avoided by government bailouts. Bernanke and Gertler's later work, Inside the Black Box, the credit channel of monetary policy transmission, published in the Journal of Economic Perspectives in 1995, and the Financial Accelerator in Qualitative Business Cycle Framework, with Simon Gilchrist, published in the Handbook of Macroeconomics in 1999, integrates financial market imperfections into what has become the standard model of business cycle and monetary policy analysis. In an influential article published in the Journal of Political Economy in 1997, Nobuhiro Kiyotaki and John Moore added a crucial element: the role of an eroding collateral value of borrowing firms and amplifying the effect of productivity shocks. Their mechanism can give rise to persistent fluctuations in output and asset prices. The crux of their theory lies in the double role of capital as a productive asset and collateral wealth. Entrepreneurs with a productive use of capital rely on external financing for their investments. In the economy, there exist borrowers who can potentially supply the resources. However, the lending process is limited by the inability of entrepreneurs to commit to fully repay their debts. The reason is that the production activity hinges on their own human capital, which they cannot pre-commit to provide. As a result, firms can only borrow against their physical assets. Fluctuations in the price of their physical assets create a feedback mechanism. In a recession, productivity declines. This reduces firms' net worth and their ability to finance investments. The effect is persistent. Since firms invest less, the discounted value of future profits declines, further reducing their net worth. This intertemporal channel strengthens the initial erosion of collateral, creating a loop that further amplifies the initial recession. The focus of the early work of Bernanke, Gertler, Kiyotaki, and Moore was on the balance sheets of firms. Subsequent studies have extended the scope of the analysis to the balance sheets of financial intermediaries. In Financial Intermediation and Credit Policy in Business Cycle Analysis, published in the Handbook of Monetary Economics in 2010, Gertler and Kiyotaki show how disruptions in financial intermediation can induce a crisis that affects real activity, and examine how central banks and governments can work to mitigate such a crisis. In Banking Liquidity and Bank Runs in an Infinite Horizon Economy, published in the American Economic Review in 2015, they further enrich the macroeconomic framework with financial market imperfections by including the possibility of bank runs. They demonstrate that the anticipation of such runs has harmful effects on the economy, even if the run does not occur.